Most people with $10,000 in savings are actually losing money right now, not because of bad luck, because of what they're not doing with it. Here's what I've noticed about money, and I've been watching this long enough to say it with confidence. The people who stress the most about growing their money tend to grow it the slowest, and the people who seem almost passive about it, almost unbothered, they're the ones quietly building something most people never will. That sounds backwards, I know. But think about what most people actually do when they get $10,000. They look for something exciting, something that feels like it's moving, crypto that's trending, a stock their friend mentioned at dinner, some opportunity that promises to double the money in 6 months. And here's the thing, it's not stupidity that pulls them there, it's psychology. We're wired to feel like doing more means getting more, like activity equals progress. It doesn't. And the cruel part? The financial world is built to take advantage of exactly that instinct. Platforms designed to keep you clicking. News cycles designed to make you feel like you're always one step behind. There's an entire industry that profits from your financial anxiety. Most people don't notice that. They just feel the anxiety and assume it means they need to act. The lazy method I'm going to walk you through isn't lazy because it requires no thinking. It's lazy in the way that matters most. It requires almost no action after you start it, and that's the part that feels wrong to most people, because if it's that simple, why doesn't everyone do it? Some will, by the end of this. Let me tell you about a guy I know, mid-30s. Decent job, not rich, not broke. And a few years ago, he came into about $12,000, bonus from work. Took him a while to save up to that point, but the bonus pushed him over. He didn't blow it. That's the thing. He was responsible. He researched. He spent 3 months reading about stocks, watching videos, following market news. He was genuinely trying to make a smart decision. And after all that, he put it into 4 different individual stocks he believed in, felt confident, felt in control. 2 years later, he had $9,400. Not because he was dumb, not because the market crashed. He just picked wrong. The way most people who pick individual stocks pick wrong. Because the research felt real. The conviction felt real. But the outcome didn't care about any of that. And here's what hit me when he told me this story. He said, "I just wish I'd done nothing." And he meant it. If he'd done nothing, if he'd just put that money somewhere boring and forgotten about it, he'd have more. He'd have significantly more. That's not a unique story. That's the default story. Most people lose not because they ignore their money. They lose because they engage with it in exactly the wrong way. Too much watching, too much reacting. Too much trust in their own ability to read a situation that professionals with Bloomberg terminals and decades of data still get wrong half the time. And there's a deeper thing here that nobody really talks about. When you're actively managing your own money, you're not just making financial decisions. You're making emotional decisions. You're scared when the market drops, so you sell. You're excited when something spikes, so you buy. You think you're being rational. You feel rational. But emotion and reason wear the same face when it's your own money on the line. This is why the lazy method works. Not because it's clever, because it removes you from the equation. It takes the most dangerous variable in your financial life, which is you, your fear, your excitement, your impatience, and it just sidelines it. Politely, quietly. The strategy I'm going to show you has one core requirement. You have to be okay with being bored. Not for a week, not for a month, for years. And most people read that and think, sure, I can do that, but they can't. Because boredom in investing feels like failure. It feels like you're missing something. It feels like everyone else is out there making moves and you're just sitting there. That feeling is the trap. Learn to recognize it. Because the moment you act on it, the lazy method stops working. The math doesn't care how you feel. And that's actually good news once you understand it. So let's talk about the actual method. And I want to be precise here because the details matter more than people think. You have $10,000. The goal is $500,000. And the path between those two numbers is not a straight line. It's a curve. A slow curve that looks like nothing is happening for a long time. And then suddenly looks like everything is happening at once. That's not a metaphor. That's literally how compound growth behaves. And most people quit right before the curve starts bending. Here's the core of what this is. You take that $10,000 and you put it into a broad market index fund, not a single stock, not a themed ETF, not crypto, a total market or S&P 500 index fund, something like VTI or VOO if you're in the US, or the equivalent in your country. Low cost, diversified across hundreds of companies, boring name, boring description, wildly effective over time. The US stock market has returned an average of roughly 10% per year over the last century. Some years it's up 25%, some years it's down 30%, but averaged out across decades, roughly 10%. And that number is the engine behind everything I'm about to show you. Now here's where people immediately push back. They say 10% isn't guaranteed. Markets can crash. What if I need the money? And those are real concerns. I'm not dismissing them, but here's what I want you to sit with for a second. The question isn't whether markets go up and down. They do. The question is, what's your alternative? Savings account at 4% that will likely drop when rates shift? Individual stocks where your odds of beating the index long-term are genuinely, statistically terrible? Doing nothing while inflation quietly erodes whatever you have? The index fund isn't perfect. It's just better than almost everything else available to a regular person. That's the honest version. So, $10,000 in a broad market index fund, and then you add to it every month, whatever you can manage. But let's say $300 a month. That's not a huge number for most people. It's less than a lot of people spend on subscriptions and takeout combined. And I'm not saying that to make you feel bad. I'm saying it because the math on $300 a month is something most people have genuinely never seen laid out in front of them. At 10% average annual return, with $10,000 to start and $300 added every month. In 30 years, you have just over $700,000. Not $500,000. More than $500,000. And the $300 a month can come down if that's too much. Even $200 a month gets you past $500,000 in that same window. Now, I know what you're thinking. 30 years. That's too long. That's my whole life. And I want to address that directly because that reaction is the exact thing that keeps this from working for most people. 30 years sounds like a sentence, but you're going to be alive in 30 years either way. The question isn't whether the time will pass. It will. The question is whether money will be waiting for you on the other side of it, or whether you'll get there with nothing because 30 years ago the timeline felt too long to bother. That's the real decision. Not index fund versus stock picks. Not this platform versus that one. It's patience versus the feeling that patience is a waste. And here's something that genuinely surprised me when I first ran the numbers properly. In that $10,000 example, you personally contribute around $118,000 over 30 years. The rest, the $580,000 or so on top of that, is just growth. Money your money made, without you doing anything, without you watching it, without you stressing about it. You contributed 17% of the final number. The other 83% came from time and compounding. Most people spend their whole financial lives chasing the 17%. The active part, the hustle, the moves. And they never sit still long enough to let the 83% do its job. That's the lazy method. That's the whole thing. It's not a trick. It's not a loophole. It's math that's been sitting in plain sight for decades, and most people walk right past it because it doesn't feel like enough. But let's go deeper, because understanding the strategy is one thing. Actually staying in it, that's something else entirely. There will be a moment, probably more than one, where you log into your account and the number is lower than what you put in, maybe significantly lower. The market dropped, your $10,000 is showing as $7,200, and everything in you will say, get out. Cut the loss. Wait until things stabilize and get back in when it's safer. That instinct will feel completely rational. It will feel like self-preservation. It is not. Here's what's actually happening in that moment. You're not seeing a loss. You're seeing a discount. Every share you buy during a downturn is a share you're getting cheaper than it was worth 6 months ago. And if you keep buying, which is what the monthly contribution does automatically, you're buying more of something at a lower price that historically has always recovered and gone higher. The people who built real wealth through index investing didn't do it by being brave during crashes. They did it by being almost indifferent. The account drops, they shrug, the automatic contribution goes in, life continues. That's not fearlessness. That's just not checking the account too often. And that sounds almost too simple. But the behavior gap, the difference between what an investment actually returns and what the average investor actually earns, exists almost entirely because people move money at the wrong times. They pull out during drops. They pour money in during peaks. They feel like they're being smart. The data says otherwise. The average investor consistently underperforms the very funds they're invested in, not because the fund failed them, because they couldn't leave it alone. This is why automation matters so much inside this strategy. You set the monthly contribution to come out automatically. You don't decide each month whether to invest. The decision is already made. You remove the choice. And removing the choice removes the emotion. And removing the emotion is worth more than almost any market insight you could develop. Now here's the part I want you to really sit with. Most people reading about compound growth understand it intellectually. They nod, they get the concept. But there's a difference between understanding compounding and feeling it. And you won't feel it for a long time. For the first 5 years, this strategy will look almost unimpressive. Your $10,000 becomes maybe $25,000. You've added $18,000 of your own money on top of that. The growth feels slow. It feels like it's barely doing anything. Year 10, maybe $65,000 to $70,000. Still feels manageable. Still feels like a number a person could realistically save on their own without any of this. Year 15. Things start shifting. You're somewhere around $130,000 to $140,000, and you start noticing that the growth in a single year is more than you contributed across several years combined. Year 20. You're looking at somewhere between $220,000 and $240,000. The annual growth alone is now more than most people's yearly salary. And then something happens in those final 10 years that almost doesn't look real when you see it on paper. The curve bends hard. Because compounding doesn't grow in a straight line. It accelerates. Every year the base is bigger. Every year the growth percentage applies to a larger number. And the last decade of a 30-year compound journey contributes more to the final total than the first 2 decades combined. That's not an exaggeration. Run the numbers yourself. The last 10 years of that journey generate more wealth than the first 20, which means every person who quits at year 12 or year 15 or year 18, they quit right before the thing they were waiting for was about to happen. They just didn't know it, because it didn't look like anything was happening. And that's the cruelest part of this whole thing. The strategy works in silence. It doesn't send notifications. It doesn't have exciting moments. It just accumulates, quietly, steadily, in the background of your actual life, while you're working and raising kids and dealing with everything life actually throws at you. The money is just sitting there, compounding, growing, doing the thing you set it up to do. You don't have to be smart for this to work. You don't have to time the market. You don't have to pick the right sector or follow the news or understand quarterly earnings. You just have to start, and then you have to stay. Starting is easy. Staying is the whole game. Most people can't do it. Not because they lack discipline, because staying feels passive, and passive feels wrong. And feeling wrong makes you move. And moving breaks the thing that was silently working. That's the trap. That's always been the trap. So here's where we land. You have a method. It's not complicated. It's not secret. It's not something that requires a financial advisor or a brokerage account with a minimum deposit or a course that costs $997. It requires $10,000, a low-cost index fund, a monthly contribution you set and forget, and time. That's the entire list. And yet, most people who watch this will not do it. Not because they don't understand it, they do. Not because they can't afford to start, a lot of them can. They won't do it because it doesn't feel like enough. Because somewhere between here and actually opening the account and setting the contribution, the feeling creeps in that this is too slow, too boring, that there must be something better they're missing. There isn't. That feeling is the obstacle. It has always been the obstacle. Here's what I want you to notice about your own reaction right now. If part of you is thinking, okay, but what about, and you're already filling in the blank with something faster, something more active, something with more upside, that's the exact instinct that has kept the average person financially stuck for generations. It's not a character flaw, it's just how we're wired. We mistake movement for progress. We mistake complexity for intelligence. And the financial industry has spent decades making sure that instinct stays loud, because a calm investor who never touches their index fund is not a profitable customer. You are most valuable to them when you're anxious. Think about that for a second. The lazy method works precisely because it ignores all of that. It doesn't respond to headlines. It doesn't care about what the Fed did this week or what some analyst said on television. It just compounds, month after month, year after year, in complete indifference to the noise, and the noise never stops. That's important to understand. There will always be a reason to pause, a reason to wait, a market condition that feels too uncertain, a global event that feels too unstable, a moment that feels like the wrong time to be putting money anywhere. If you wait for the noise to stop before you start, you will never start. The right time to plant the seed was 20 years ago. The second right time is now. Not next month when things feel more settled. Not after the election. Not when you have a little more clarity on where things are headed. Now. With whatever you have. In whatever account you can open this week. Because 30 years from now, you will either be the person who started, or the person who kept waiting for the right moment and never found it. And both of those people exist right now. One of them is making a decision today. The other one is telling themselves they'll think about it more and figure it out soon. Soon is the most expensive word in personal finance. Most people will hear this and still miss it. They'll nod. They'll feel something shift for a moment, and then life will pull their attention somewhere else and the moment will pass. But a few will understand exactly what to do next. Not because they're smarter, because they're honest with themselves about what's actually been holding them back. If you're one of those people, if something in this landed differently than you expected, then stick around, because this is the kind of thing I talk about here, not the loud version of finance, not the exciting picks and the trending tickers, the quiet stuff, the stuff that actually works over time for real people without drama. Subscribe if that's what you're looking for, not because I need the number, because if you're serious about this, you probably shouldn't be watching it just once.